Long-term care insurance needs analysis. By the end of this lesson, you should be able to realize some of the factors, both known and unknown, that need to be considered when determining a client's long-term care need. Long-term care is about managing uncertainty. Some of the variables impacting the purchasing decision and amount of coverage needed are the uncertainty of the need. So, will it actually be needed to start with, and if so, at what age and for how long? Medicine is not curing disease, but it's allowing us to live longer. As a result, with an increase in life expectancies, there's a chance that as we age, we won't be able to take care of ourselves. So this need for custodial care. We don't need to be in a hospital, but we can't take care of ourselves for activities of daily living. Eating, bathing, toileting, transferring, walking, those sort of things. So again, it's an uncertain factor there, and it has been difficult for insurance companies to price this accordingly. Second bullet point, the actual daily cost of care. What's the actual daily cost of health and custodial care at the time when it's needed? Typically, medical inflation has been increasing at a much faster rate than general consumer inflation. So again, it's difficult to tell what it's going to be 15, 20, 25 years in the future. Next is the financial capacity of the person. What assets are going to be available to pay for long-term care? The person might be a high net worth individual, but if the assets are fairly illiquid, they may want to look at getting a long-term care policy. If the person's middle income, not high net worth, but is afraid of totally exhausting their reserves for retirement and going into a dependent situation of Medicaid or Medi-Cal, again, that's another factor, financial capacity. Fourth bullet point, future legacy. Does the person want to leave a legacy to their heirs or to a charity? And the last is extended life expectancy. Covered this in the first bullet point, but again, knowing that as medical procedures improve, how much longer will this person live, and what will their quality of life be? So, who should purchase long-term care coverage? Basically, risk-averse individuals who are not willing to hold potential catastrophic risk on their own. Individuals with assets to protect. And typically in the industry, the threshold has been if the person has a net worth of $2 million, they can just retain this exposure and deal with it and not be totally wiped out. The third point, individuals over age 50 with financial capacity to pay and continue to pay for those premiums. And no, generally long-term care insurance is an important component of a client's risk management puzzle by the age of 50 to 65, typically the peak earning years. However, it is important to discuss earlier purchases and document those discussions. So determining the amount of coverage needed. The amount of long-term care coverage needed is affected by numerous personal factors, including risk tolerance, health status, and will they be able to qualify, family health history, especially if cognitive disorders come into play, the type of care desired, whether they want to stay at home or go to a nursing facility, that's going to be one of the factors too, and the availability of alternative caregivers that can assist, whether it's a family member in the household or someone you're hiring from a care service. Additionally, the future net wealth and retirement cash flows need to be incorporated into the decision, as well as any legacy wishes. So assessing benefit and cost factors. Project the per diem cost. What's it going to cost per day for care in the future? Do a survey locally to see what care facilities are charging so that you have a better feel for it. California, where we are, is a big state. You have some very expensive areas and some very affordable areas. If you're in a financial planning practice that is in an affluent town, well, again, you're probably going to be paying more than average for that coverage. If you're in an area that is not very affluent, that the cost of coverage may be less. So again, that needs to be explored. Benefit period. This is something that is actively changing in the marketplace. A point to consider is a minimum benefit period of 5 years. Some of the averages that our underwriters have communicated with us have been that females typically live 5 years once they go on care. Males typically live 2 to 3 years once they go on care. So again, something to consider is, one, what benefit can I purchase? Is it available? 5-year, 10-year? The traditional lifetime that was in play for a couple decades largely is gone from the marketplace at this point because it's too much uncertainty to the insurance carrier and pricing it has become too difficult. Third bullet point, home health care. Consider a policy that provides 100% home health care. So 100% of the cost of home health care. Most people don't want to go to a nursing facility. They want to stay at home. And for example, the CalPERS state of California long-term care program, it is not long-term care insurance, but it's offered to state employees, does offer home health care, but it's half the daily benefit that would otherwise be paid out if they were in a nursing home or other care facility. So that's an important thing to look for. Next is elimination period. In the prior PowerPoints and lectures we've done on disability, this works very similar to disability elimination period. The disability period is chosen by the insured. Depending on the company, it can be as short as 30 days or as long as a year, with 60, 90, 120, 180. Again, it'll vary by carrier. There's no magic formula on that. Rule of thumb, the bigger the elimination period, the longer the period, the more affordable the policy. The impact to the client is they should have the funds in reserves that they can cover that initial cost without throwing the family into hardship. And also, maintaining purchasing power is important, especially for younger clients, because they have a longer time horizon before they'll potentially go on claim. So you want to look at whatever compound benefits are available for increasing coverage. Typically in the marketplace, the only option is 5% simple or 5% compounded. And again, look at the impact of premium when reviewing the long-term care quotes with the client. So some of the gap analysis. How much insurance should be purchased? Well, just because on the income gap side, just because long-term care may cost $55,000 a year doesn't mean you need $55,000 worth of coverage. You'll probably have some source of retirement income, such as Social Security or annuity income, or if you're lucky enough, a traditional defined benefit pension. So, for example, if your total retirement income is $20,000, you only need $35,000 worth of insurance. That means instead of a daily benefit of $150, you can get by with $95. So the long-term care policy plus the other fund sources will meet up to cover the whole need. And how much insurance should be purchased? Well, cover the most likely risk. Couples don't need to buy the same amount of coverage for each individual. Because women live longer, they're more likely to need the care. Also, take family medical history into account when choosing how much insurance to buy. A note on the underwriting process, medical history has a direct impact on the ability of a client to not only qualify for standard or preferred rates, but qualified, period, just to get the policy. So a case study for you here. Let's assume that Elmer and Irene are thinking about purchasing long-term care insurance. Some of the facts that we have. Elmer's family has a history of heart disease. He's in his mid-50s. Irene, also in her mid-50s, has a mother age 79 who's in good health and living independently in her own home. Irene's father died 3 years ago of a heart attack. Irene's mother's sister, Irene's aunt, age 84, has Alzheimer's. The home is valued at $90,000 in a nice area. They have $75,000 in savings, including a tax-qualified retirement plan. And Elmer's worked for a local manufacturing plant for 27 years and is making $48,000 a year. Irene's not working. And Elmer wants to retire at age 62. Should Elmer and Irene buy long-term care insurance? Well, what they know. At this time, they do know their ages, their health, and their family's health history. They also are aware of their assets, as well as the cost of nursing homes in the area. They also know the cost of insurance coverage they need, and some facts about Medicare. Medicare does not pay for long-term care cost, only skilled care. Medicare pays for nursing home care, but only after you qualify for it financially, so you have to spend down those other assets. And they're also aware of the increasing risk of needing nursing home care. So a question, should they pay the insurance company now into the future to transfer the risk of losing their assets to the nursing home later? Some of the unknown variables. They don't know what age they'll need to use the policy, if at all. If they pay premiums for 20 years and die suddenly, well, there's nothing to collect on. So again, it's an unknown. The average person has an extended stay in a nursing home around age 80 or so on average. They can expect to pay the insurance company for 25 years before they'll need the coverage. On the second point there, in 2025, when Elmer and Irene are most likely to need coverage, what other variables will be? Oh, we don't know. Societal changes, changes to government programs, changes to the private market. We don't know these things yet. Could more diseases be cured in the future, negating the need for long-term care, and we'll have a bunch of healthy seniors running around? We don't know. So, more of the unknowns. Will Elmer and Irene have assets to protect in 2025? So, again, we can't control the investment markets. We don't have crystal balls. What coverage will they need? The fact that long-term care coverage is almost certain to change significantly in the next 25 years is really first and foremost. What will home health care look like? Will there still be nursing homes? Or will long-term care be delivered in ways that we can hardly even imagine today? Additionally, what will the cost of care be? Should we look at historic costs of nursing home care and extrapolate that 25 years in the future? Their figures show in 25 years the annual cost of nursing home care will be $250,000 compared to only $50,000 today. Additionally, we don't know what the long-term care system will look like in the future, let alone the cost of services will be, and what will the long-term care financing system look like in 2025. Changes to Medicare, Medicaid, means testing come into play. So again, we don't know these things. So let's compare some other types of insurance to long-term care. Elmer and Irene buy homeowners insurance because they cannot afford to replace the home if it burns down. They know that the risk of loss to their home does not change over time, and the government won't pay to replace their house, so they don't mind paying a small premium today to transfer a large risk to the insurance company. So, by contrast, even though at their current ages the premium is small for long-term care, the risk of needing to use the policy is also very small too at this point. As time goes by, the risk of needing long-term care coverage will increase, and by how much, though, is an unknown variable. So what's the purchase decision going to be? And given the other unknown variables, what's the risk of their needing to use their long-term care insurance? In short, how do Elmer and Irene know their policy will have any value when they need it? In the face of these unknowns, should Elmer and Irene pay the insurance company for a long-term care policy? If you were advising Elmer and Irene, what would you recommend they do? So to summarize, we've reviewed the factors that need to be considered when determining the client's long-term care need. Thank you for your time.